Okay, let's unpack this. Uh, Natural gas futures, they're up today, which seems odd, right?
Yeah, definitely odd given all the talk about oversupply and, well, pretty mild weather.
So what's really going on? That contradiction is exactly what we're going to dive into right now.
It's fascinating, isn't it? You have these bearish signs, lots of gas in storage, demand looking weak, but something else is pushing prices up.
Exactly. So we need to look a bit deeper than just the immediate numbers.
Right.
For this deep dive, we've pulled together info from Natural Gas Intelligence, FX Empire, we've got White House documents, Beat Americas, This Day Live, and the News International too.
A good mix of sources.
Yeah, and our mission here is really to help you, the learner, quickly grasp the main things moving the natural gas market and, see how it connects to the bigger energy and national security picture.
Without getting totally lost in the weeds, hopefully, we want to pull out the key insights.
Exactly. So we'll look at the gas prices, sure, but also this new push from the Trump administration on nuclear energy.
Oh, that's a big one.
An investor moves in oil and gas, plus what OPEC Plus is up to.
Yeah.
Let's start with the gas market itself. What's driving that price bump today?
Makes sense. So, what are the sources saying about that specific move?
Well, NGI and FX Empire noted that the June NYMEX futures, they actually lost ground earlier in the day, but then reversed. By midday, May 23rd, they were up a bit, hitting 3.305 cents per MM2.
Okay, a modest gain, but still a gain.
Right, and this is happening just before the Memorial Day weekend, and also as that June contract is getting close to expiring.
Contract expiration. That always stirs things up.
And there seems to be this anticipation, maybe, thinking about summer heat kicking in and boosting demand.
So it could be short-term trading sentiment, kind of overriding the fundamentals for a moment. People betting on future heat.
Seems like it. Because the fundamentals earlier were definitely pointing down. The EIA, the Energy Information Administration, reported a pretty big storage injection, 120 billion cubic feet. That was for the week ending May 16th. And that's more than the 5-year average for that time of year.
Okay, 120 BCF. Yeah, that pushed total gas and storage well above the average too, right?
Exactly.
Yeah.
So supplies look pretty comfortable, which normally means, stable or lower prices.
Right. And the weather wasn't helping demand either.
Nope. Forecasts for the Midwest and East were wild. Less need for heating, not quite AC season yet everywhere.
Plus, I think I saw something about solar power performing well.
Yeah, strong solar output was apparently offsetting some of the need for gas-fired electricity generation. Another little pressure point on gas demand.
And what about regional issues, like the Permian Basin?
That's another key thing. Spot prices there actually went
Negative prices. That basically means they were paying people to take the gas away, right?
effectively, yeah. It screams regional oversupply and, crucially, not enough pipelines to get the gas out of there.
Even while national production is still pretty high, over 105 BCF a day, so it's a transport bottleneck.
Right. Definitely looks like it. Now, technically speaking, analysts are watching the 200-day moving average.
The technical charts. Where's that sitting?
Around 3.176 cents. If prices break below that level, it could trigger more selling, technically.
Okay, so summarizing the gas market then. High storage, mild weather, strong solar, regional bottlenecks, all bearish.
Yep.
But the price ticked up midday. It really seems like that pre-holiday contract expiration, summer hope dynamic just took over, at least for a bit.
That's the snapshot. But let's pivot now, because there's a potentially huge long-term factor emerging. This major push by the Trump administration into nuclear power.
Right. This feels like more than just energy policy. It's deeply tied into national security thinking.
Absolutely. The White House put out a fact sheet and an executive order, this was also on May 23rd, outlining a really aggressive plan.
Aggressive how?
The main goal is rapid deployment of advanced nuclear tech. And the focus is very specific, powering AI infrastructure and national security sites.
Powering AI. That makes sense given how much energy those data centers consume. They need reliable, dense power.
Exactly. And they're not messing around with timelines. The order mandates a program to actually build a nuclear reactor on a domestic military base within 3 years.
3 years. Wow, that sounds incredibly fast for anything nuclear. What are the hurdles there?
Well, you'd think regulations, finding the right people, getting the fuel, it's a huge challenge. But the order signals they want to cut through the red tape for national security.
Okay. What else is in the order?
Well, AI data centers, if they're at or working closely with Department of Energy facilities, they get designated as critical defense facilities.
So extra protection, extra importance.
And their nuclear power sources become defense-critical electric infrastructure. Plus, the Energy Secretary has to work with private companies to get advanced nuclear running at DOE sites within 30 months.
30 months. Okay, again, very fast. They're really trying to accelerate this.
It seems, though, they want to remove government barriers for private investment at federal sites.
How are they offering incentives?
One specific thing is releasing 20 metric tons of HALEU, that's high-assay, low-enriched uranium, into a fuel bank.
Ah, HALEU. That's the special fuel many advanced reactors need, and supply is a big concern.
Exactly. This fuel bank is specifically for private sector AI projects at DOE sites.
Makes sense. What about the rest of the fuel cycle? Spent fuel, reprocessing.
They're tackling that too.
Hmm.
The Energy and Defense Secretaries are directed to help enable privately funded fuel recycling, reprocessing, and even fuel fabrication at federal sites.
And environmental reviews. Those usually take ages.
They're looking into using something called categorical exclusions under NEPA, the Environmental Policy Act, to speed up reactor construction on federal land.
Okay, so streamlining regulations, providing fuel, encouraging private investment. It's comprehensive.
Plus, prioritizing security clearances for people working in the nuclear sector. And it's not just domestic.
They're looking at exports, too.
Big time. Promoting American nuclear tech abroad through diplomacy, financing, support, trying to counter the dominance of foreign reactor designs and fuel suppliers.
What's the stated reason for all this?
The White House rationale is pretty clear. Needing that uninterruptible high-density power for the military, especially in remote spots, and for AI.
And reducing reliance on foreign energy.
Right. Bolstering national security, cutting foreign dependence, and pushing back against figures they cite like 87% of new global reactor builds using foreign designs, and most fuel coming from overseas.
It ties into a broader industrial strategy then.
Seems like it. There was another related executive order the same day focusing specifically on managing spent fuel, developing reprocessing, expanding domestic uranium enrichment.
So really trying to rebuild the whole U.S. nuclear industry from the ground up. Fuel, reactors, workforce, licensing.
That looks like the goal. Jumpstart the whole thing.
Okay, that's a massive potential long-term shift. How does the financial world see the current energy landscape, though? Let's look at investor activity in oil and gas.
Good transition. MarketBeat had some data on Northern Oil and Gas, or NOG. Nuveen Asset Management, a big player, actually cut its stake in NOG by about 10% in the fourth quarter.
Okay. One major investor trimming their position could signal some caution about that specific company or the sector.
Maybe, but it's not the whole story. Several other large investors actually increased their holdings in NOG during that same period.
Ah, so a mixed picture, diverging views among the big money managers. What about analysts?
Also mixed. The overall consensus rating is hold. The average price target is around $39.67.
But any recent changes?
Yeah, some analysts have actually lowered their price targets recently, maybe reacting to some of the uncertainties we've been talking about.
But the company itself, NOG, are they doing anything? Dividends? Buybacks?
Both, actually. They announced a quarterly dividend payable end of July, and they started a share repurchase program.
Okay, so returning cash to shareholders, trying to support the stock price, that usually signals some confidence from management, or at least a desire to keep investors happy.
So yeah, like you said, a complex picture for NOG. Some selling, some buying. Analysts are cautious, but maybe trimming targets. Company paying dividends. Reflects the broader uncertainty, I think.
Definitely. Now, let's zoom out again to the global stage. OPEC plus Kayla. What's their game plan, especially regarding U.S. shale? This feels important.
Very. The News International and Thursday Live reported that Russia is actually planning to sign a formal partnership deal with OPEC.
Formalizing the OPEC plus alliance that's basically been running things since, what, 2017?
Exactly. They're talking about doing it at a December meeting, maybe implementing by January 1st. It makes the cooperation official, long-term.
And what's the strategy coming out of this bloc?
Well, it looks like OPEC plus Al, led by Saudi Arabia and Russia, is planning to increase oil output.
Increase, not cut. Why?
A key reason seems to be to specifically challenge U.S. shale producers and try to claw back some market share they've lost over the years.
We've seen this movie before, haven't we? The price war about a decade ago didn't exactly crush shale then.
True. U.S. shale proved really resilient, cut costs like crazy. But the context might be different now.
How so?
Well, reports suggest U.S. shale costs have actually been rising over the last 3 years. And lower global oil prices, partly maybe due to things like tariffs, are squeezing their income.
So they might be more vulnerable this time.
That could be the calculation. OPEC plus sources are apparently hinting that pushing prices below, say, $55–60 a barrel might be enough to seriously disrupt U.S. shale drilling plans.
55 to $60. That's quite a bit lower than recent prices. They're not calling it a price war, but
It would feel like one of shale producers, right? Saudi Arabia especially has incredibly low production costs. They likely feel they can wait it out.
and Russia's costs are higher than Saudi's, but still much lower than U.S. shale, so they're aligned on this.
Reportedly, yes.
Hmm.
And this is happening just as some of the prime drilling spots in the Permian, the best areas, are getting depleted.
Which means U.S. companies have to drill in less productive areas, pushing their costs up even more.
Exactly. Some estimates put the break-even price needed for new U.S. shale wells around $65 now. Compare that to Saudi Arabia at maybe $3 and Russia maybe $10–20. It's a big gap.
So the cost advantage for OPEC Plus looks more significant this time around. Are we seeing any impact yet?
Some U.S. shale firms are already lowering their production forecasts. They're citing economic uncertainty and, yes, rising OPEC plus supply.
So the pressure might be starting to bite. But hang on, wouldn't a long period of $55 oil hurt Russia and Saudi Arabia too? They need higher prices to balance their national budgets, don't they?
Absolutely. That's the gamble. They have higher budget break fins. So it's a risky strategy for them as well. A real high-stakes game focused on market share this time.
Potentially leading to a lot more oil price volatility.
Okay, now, briefly, you mentioned a bridge project in Chile. How does that fit in?
Right, the Palani and Rossellot bridges. It seems random, but the source, Beat Americas, highlights infrastructure development.
And the thinking is better infrastructure eventually means more economic activity, which means more energy demand. Kind of, yeah. It's a long-term thing. Improved transport, regional growth, it all feeds into the larger energy demand picture down the road. Not a direct driver today, but part of the background tapestry.
Got it. A reminder that local projects can have wider long-term energy implications.
Exactly. So let's try to bring all these threads together.
Okay. The natural gas price jump.
Seems like a short-term market quirk, right?
Yeah.
Contract expiry, summer hopes, kind of overshadowing the bearish fundamentals like high storage for now.
While the Trump administration's nuclear initiative, that's a potential long-term game changer. Driven by national security, especially AI's power needs, it could really shift future energy demand away from gas in certain areas.
Definitely. And then OPEC Plus's strategy targeting U.S. shale injects a whole lot of uncertainty and volatility into the oil market.
Which spills over into gas sometimes, as power plants can switch fuels depending on price. The success of that OPEC Plus strategy is still a big question mark.
And finally, that mixed investor sentiment in companies like NOG just reflects all this uncertainty. People are hedging their bets.
So the key takeaway here, that simple headline about gas prices is just one tiny piece of a really dynamic, interconnected global energy puzzle.
You've got short-term trading, major policy shifts like nuclear, geopolitical battles for oil market share, tech needs like AI. It's all interacting.
Understanding these underlying forces is pretty crucial, wouldn't you say? Whether you're in business, watching the economy, or just trying to stay informed.
Absolutely. It gives you the framework to make sense of the day-to-day news.
So here's something to chew on as we wrap up. If this nuclear push for national security really takes hold, how profoundly could it reshape U.S. natural gas demand over, say, the next 10 years?
And what are the unintended consequences, the ripple effects, of this renewed, maybe more intense competition between OPEC Plus and U.S. shale? Could it backfire on OPEC Plus meddling? Could it accelerate energy transition moves elsewhere?
Lots to think about. Hopefully this deep dive gave you a good starting point for exploring those questions yourself.